Hello, everyone. This is part two, the ratio analysis, second part. We'll see efficiency ratio, profitability ratio, and the market value ratio. First part is efficiency ratio. This is also called the asset management ratio. So this ratio measures how efficient we use the asset. First two, it's about inventory. So inventory turnover measure how quick we sell your inventory. If we sell out inventory quickly, more quickly, then the amount of inventory will be relatively low to the cost of goods sold. So inventory turnover will increase. For profit, inventory turnover is COGS 1,344 and inventory is 422, 3.18 times. That's inventory turnover. You can also measure average number of days to sell out inventory, which is called the days sales in inventory. 365 divided by inventory turnover. Because inventory turnover is 3.18, days sales in inventory equals to 365 divided by 3.18, 114.61 days. It means that on average, this company takes 114.61 days to sell inventory from purchasing inventory. Next, to measure the efficiency of the cash collection. So how efficient we collect cash. If you collect cash more quickly, more efficiently, then the amount of account receivable decreases relative to the sales. So receivable turnover increases. So for this case, the sales is 2,361. And then account receivable is 188. 12.56 times. Like day sales in inventory, we can also measure the average number of days to collect cash, called the day sales in receivable. See, 365 divided by receivable turnover. So 365 divided by 12.56, 29.06 days. So it means that this company takes on average 29.06 days to collect the cash, collect the account receivable from sales. Next is about payable, how long the company hold a payable. So if company hold a payable longer, the accounting payable relatively higher to the COGS, cost of goods sold, the payable turnover decreases. So days cost in payable is number of days the company holds a payable, 365 divided by payable turnover. So 365 divided by 3.91, which is payable turnover, 93.42 days. So this company takes 93.42 days on average to pay their payables from purchasing inventory. Final one is the total asset turnover. How efficient the company uses asset. Sales divided by total asset means if company use asset more effectively, then their sales higher than, relative to the asset, right? So asset turnover increases. For prop, sales is 2,361. Total asset, 3,630. So 0.66 times total asset turnover. The next pop quiz, calculate daily sales inventory, payable turnover, and total asset turnover. Please solve. To get the day sales in inventory, we need to get the inventory turnover first. Inventory turnover equals to COGS, cost of goods sold, divided by inventory. The cost of goods sold of this company is 184,317. Inventory is 21,956. Inventory turnover equals to 8.39 times. From this inventory turnover, days sales in inventory is 365 divided by inventory turnover, 8.39, 43.48 days. The company takes on average 43.48 days to sell the inventory. Payable turnover equals to cost of goods sold divided by account payable. Cost of goods sold 184,317. Account payable 3,986. It's 46.24 times. Total asset turnover equals to sales divided by total asset. Sales is 229,854. Total asset 115,672. 1.99. That's how to calculate these numbers. Profitability ratio. Profitability ratio measure the profitability of the firm, how profitable the firm is. First one is profit margin, net income divided by sales. It's about the cost of control. How efficient does company control the cost? So if company control the cost effectively, then net income will be higher relative to the sales. Profit margin increases. For profit, net income is 474. Sales is 2,361. So profit margin is 20.08%. Next measure, very famous. We usually call it ROA, return on asset. It's net income divided by total asset. How much the company earns relative to the size of the firm. Net income 474. Total asset is 3,630. 13.06% ROA. Since we are more focused on the equity holders value, because equity holders are shareholders, remember the goal of financial management. ROE, return on equity, is also very interesting measure, very important measure. It's net income divided by total equity. Net income 474, total equity 2,620. 25, 18.06% return on equity. So next pop quiz, calculate profit margin, ROA and ROE. Please solve. The profit margin equals to net income divided by sales. Net income is 27,647. Sales is 229,854. 12.03%. ROA equals net income divided by total asset. Again, net income is 27,647. Total asset is 115,672. 23.90%. Finally, ROE equals to net income divided by total equity. So net income is 27,647 and total equity is 92,189. ROE is at 29.99%. The final category of the ratio is the market value ratio. Market value ratio measures the the company's value in the market. It's actually related to the stock price. So we need to have more variable in addition to the financial statement. It's market information. So suppose market price is $115 per share and shares outstanding is 33. The first measure is the earnings per share. It's called EPS. This measure equals to earnings, net income divided by number of shares outstanding. So earning is 474, number of shares outstanding 33, EPS is $14.36. This is net income per share, per one share, one stock. The next two ratio is very related. Let's look at the first one. PE ratio is the price per share divided by earnings per share. For this company, 115 is stock price per share, divided by earning is $14.36, EPS 8.01 times. This PE ratio indicates how much investors are willing to pay for $1 of the current earnings. Higher PE usually means that the firm has significant prospects for the future growth. But this is not always the case. If the firm has almost no income, very low income, PE will be high. It's not really good prospects, right? Sometimes, in many cases in the market, too high PE ratio is indicator of the overprice of the stock. So it doesn't really mean that it's high prospects again. So interpretation of PE ratio should be very careful. If the company generate negative earnings, so they lose money, PE ratio will be negative, no meaning. In that case, price to sales ratio may be used. It's very useful for the starting a company. For starting up, many companies lose money. Instead of PE, price to sales ratio may be used. So the ratio, price to sales ratio is price 115 divided by the sales per share, which is sales 2,361 divided by number of shares 33, so 1.61 times. The next one is market to book ratio. This ratio compares the market value of the firm with book value of the firm. Book value is the seed money cost of company. Book value per share can be calculated by the total equity divided by number of shares outstanding. For Prufrock, is 2,625 total equity divided by 33, 79.55 will be book value per share. So market to book ratio is 115 divided by 79.55, 1.45 times. If the market to book ratio is less than one, then it means firm is not very successful in creating values for shareholders. So this measure is one of the measures that show the firm value, creating firm value. Now, the next two, this focuses more on the operating value, operating asset value. Enterprise value is the estimate of the market value of the company's operating asset. One way is you can get each asset's market value and add them up. That's it. But the problem is in real world, it's very hard. It's impossible to get an individual asset's market price. Instead, because you know that the asset should be the same as the sum of the liability and the equity, the stocks. If you can get the market value of the liability and the equity, then we can get the market value of the asset. Market value of the equity easy, that's the stock price. So total market value of the stock is the first factor. The second factor is the liability market value. The issue is it's also impossible to get a market value of the liability. However, book value of the liability is very close to market value of the liability, so it's going to be a good proxy. So sum of the total market value of the stock plus the book value of the liability will be good estimation of the total market value of the asset. And if you subtract cash, then that's operating asset. So total asset except cash is called enterprise value. So if you calculate this, 115 times 33 will be the total market value because that's market value per share times shares outstanding plus book value of the all liability is the total asset minus total equity. So 3,630 asset, 2,625 the equity, that's the book value of the liability. Subtract by, again, cash, 98, 4,702 is enterprise value. After enterprise value, you can compare enterprise value versus earnings before interest, taxes, depreciation, and amortization. This is called EBITDA. And this ratio called EBITDA ratio. First of all, EBITDA is a measure of the operating cash flow because we add non-cash item back. EBITDA is useful for analysts who want to look at cash flows from business operation independent of financing cash flows. And then this EBITDA ratio here, so EBITDA ratio will be the enterprise value 4,702, and the EBITDA is EBIT plus depreciation because we don't have amortization for this company. 1,017, 4 times 4.62 times. This ratio provides the ratio of the value of operating asset over operating cash flow. Similar to the interpretation of the PE ratio, the EBITDA ratio provides a price for a dollar of operating cash flow. Okay, so these are all ratios we learned when you look at the ratio, you have to do at least the two things. One, you need to know how to calculate. Number two, you need to know the meaning of ratio. So focus on calculating ratio plus meaning of ratio. And because we don't require you to memorize this ratio, you don't have to worry about memorizing it. However, many ratios will be automatically memorized because we will use this ratio in the future, not just for this class, but also in your career. These are key factors that you need to know. Okay, so this is the end of the second part, which is the ratio analysis. And then the third part will look at application of the ratio analysis. See you in the next part.